very few developers really do know what the bank needs. If you're prepared to spend the money up front, the speed of the development finance transaction can be tripled, but it costs money. None of our transactions is straightforward, none of them. I have not seen a single straightforward transaction in my entire career. We sell risk, we take risk, we price for risk. And then you see the number in the end, the GDV. That's the number, that's the right number. The fact that it doesn't match the developer's expectation has got nothing to do with downval. Every single transaction with first-time developers, everyone will say, oh, they have experience. But when you look at the experienced team around them, they're not that experienced. Like, you really need to dig deep. Who are the people behind it? Somebody who understands this inside out and can plan for this correctly is gold. Now, that is the most overlooked item in the process. And you would know that better than anyone else. You can speed up development finance transaction 3 times. How can you do that? Simple.
Hello everybody and welcome to another episode of Property People. Today I'm delighted to be joined by Uliana Kuzmis. How are you today, Uliana?
Oh, amazing. Thank you so much, Sam. How are you?
Very good to have you with us. I'm great, thank you for asking. And I'm incredibly excited to talk to you today, simply because we're talking about finance and we're talking about development finance. These are the things that I'm very excited about outside of, in the realm of property. But before we get into it all, I just want to do a quick little intro because you're the Deputy Managing Director of the award-winning Development Finance Division of Hampshire Trust Bank, which is commonly referred to as HTB.
HTB, correct.
Hampshire Trust Bank specializes in residential and commercial development finance and can offer creative and customized loans to experienced property professionals on facilities ranging from as little as £1 million up to £25 million. Which is pretty impressive. And you've got quite the track record as well of what's brought you to this position. So before we go into all the details of your career and your take on property in the UK and development and finance, I'd like to know a little bit more about you and who were you at school? Were you a academic person or were you...
Oh boy.
A
Okay.
misfit?
Thanks, Sam. Thanks for the introduction as well. I was an academic rebel. So I did very well in school. I was the second highest ranking student when I graduated.
Wow.
But also, I was very much a justice fighter. So I know it sounds odd, but if we had teachers who potentially didn't treat students well or were mean or just were not fair, I would be at the front fighting for the students, fighting for my classmates. In fact, we went as far as boycotting one of the teachers who was exceptionally mean.
No way.
And we got a whole parents committee to kind of get behind us, and parents took turns coming to sessions and sitting in lessons to make sure the teacher behaved. I think that school probably will never forget me.
Yeah. And what country was this in?
That was in Russia.
In Russia. So
Very
you
brave.
But you know, it sounds like you were very smart. Obviously, to be academically that bright, to be that to be the top of your class effectively, and then to be a justice warrior at the same time. You could be. It's disruptive, certainly, but in a good way.
Thanks for saying it. I think I was just hardworking rather than smart. I put the effort in. But yes, I had some advice from like an employment psychologist when we finished school, and she said I should become a lawyer because my sense of justice is quite it's quite profound and strong, and it leads my actions. I think I would have been a good lawyer, actually.
And yeah, absolutely. So when you were studying, you were doing so well. I'm sure that grown-ups around you were saying, like, you can do this, you can do that. Like, what was your dream at that time when you were, 14, 15, 16? What were you thinking that you wanted to do when you grew up?
Okay, this is odd. So that's a good question. I had this vision of working in an office, in a bank. And there is this actually visual of me standing next to a floor-to-ceiling window, somewhere high with gorgeous view of the city and blue sky and all. And that vision has always been there, even though as a little girl in Russia, you don't have that. You don't have office buildings, or at least where I grew up, which is Far East, you don't have office buildings. You don't have swanky, snazzy sort of spaces and stuff. The banks all, now things have changed, but I left so many years ago, I don't actually know how it's now. But at that time, I did have that vision. And interestingly enough, our office right now is in the 9th floor of grade A, newly built office space in the city, overlooking the city and the Gherkin and everything. So, and we do have floor-to-ceiling windows. So it's just dream come true, effectively.
Literally, and it's a bank.
It is a bank, 100%. It's a bank. Yes.
Very good. Well, literally, dreams do come true. I'm a firm believer of that. Nightmares can also come true as well in life, but certainly, I think for the vast majority of humans on this planet, that our dreams are able to come to reality. And you're one of those ones that can be the living proof of that.
It's maybe the power of visualization as well. When you see what you want, when you know what you want, you're going to get there, right?
Were you apart from that one teacher, that were you positively inspired by the grown-ups around you? I know friends, family, other teachers. What was the inspiration?
Yes, I was positively inspired of what not to become.
Oh wow, that's an interesting way of looking at it.
It's true. The environment I grew up with was quite rudimental. It's a long story. It's a big story. But no, I left Russia when I was 17, and I was quite fortunate to study in Jerusalem and Israel. Just completely different culture, completely different background, completely different adventure and a journey. And I'm really grateful to have had that journey, because the learnings I took from it, the changing the culture, changing the country. I studied in a different language. I had to learn Hebrew in order to study in Hebrew university.
Wow.
It just gave me so much in the process and in the journey. And of course, I have been in the UK for the last 17 years. So that's a third country, third cultural exposure. It just gives you this breadth and wealth of depth and wealth of knowledge and experience that hopefully helps.
And third language as well, because if you've got Russian in one, you've got Hebrew in the other, then you've got English. I mean, were you speaking English from a young age or always? Because your English is so good that I would have thought that, okay, if we went from Russian to English, you'd learn a second language, but to have also learned Hebrew and to be able to study at higher education and learning from the age of 17, that's all quite impressive stuff.
Sam, you're going to laugh. When I came to London 17 years ago, I was employed by Mizrahi Tfahot Bank, which is an Israeli bank in London that has got branch in London. I couldn't speak English.
Oh.
I could not say anything in English. I came in, I had the knowledge they needed, which was knowledge in Israeli mortgages, but I did not have the language. And I was lucky enough that they took a hit and they took me in, and they hired an English teacher who's coming to the office to work with me twice a week. And every morning on the tube, I would take this Oxford Grammar book and I would work the exercises on my journey into the office and then on my journey back. And I had to really escalate that learning. I could not write a simple cover letter for the offer letter, which says, please sign and close your offer letter. You know, please sign in 2 copies and return back to the bank. I couldn't do that.
Unbelievable. That is really impressive. So going from Russia to Jerusalem, and then to study. So what did you study?
I studied communications and journalism first. And then I always wanted to study economics because, of course, the vision of working in the bank and financial sector.
Sure.
Always wanted to study economics. But economics was really difficult faculty to get into. And the bar was very high. And also the drop-off rate was extremely high. It's about 50%. And I remember at that time, I was only about 3 years in the country. My Hebrew was getting there, but still not quite strong. And I wasn't sure I can do this. And I started studying journalism, but that economics kept sort of stayed in the back of my mind, thinking, but that is what I really want to do. This is where my heart is. This is what I really want to go for. And one day, I just kind of gathered the courage, and I thought, surely, if some people can do this, I can definitely do that. You know, it's within reach. It's something if I put my mind to it, I can do that. And I went for it, and I got accepted to economics. And I realized that my mind is actually very suited for that way of working and thinking. It's all about efficiencies. It needs to make sense. There is a supply-demand imbalances, and I get all of that. So whatever learning were coming my way, it was almost easy for me. Yeah. And I feared for no reason, effectively. I did really well, and I absolutely loved it, and I'm glad I did it, because I would have regretted it otherwise.
Absolutely, you don't want regrets. That's the last thing you want. So the move to the UK, how did that come about, and getting more involved in? It was what was the name of the bank that you the Israeli?
Mizrahi Bank.
Right. So I've been in finance, but I've not come across that particular bank. What are they about? What do they do? And why do they need your skills in the UK?
They have quite strong presence in the UK. They have a branch in London that mainly focuses on Jewish community. Now they also service Indian community, because they have some strong connections with the Asian Jewish business networks.
Sure.
And what they had is they had an Israeli mortgages department. And as it happens, I was a senior mortgages advisor in Israel. And also I had a chance of being a branch manager in Israel before I left at the age of 25. I was a maternity cover, and I had a chance to go to one of the branches and just make it my own. And when I met my husband, who proposed, and I was moving to London, we popped down to Mizrahi in London and wanted to look whether there's any opportunities for employment. And it transpired that the set of skills I had was exactly what they needed.
Oh, wow.
And they did not hesitate. I had this job offer in a matter of days.
And so the job spec, exactly, bullet points, what was it that they were looking for that you had?
They had Israeli mortgages department in London, which effectively provided mortgages in the UK for Jewish people to buy properties in Israel. And there's lots of demand for this. Lots of Brits wants to own a house, a home in Israel, holiday homes or second family home, etc. So there's a huge market for that, and all the documentation was in English. The loans were here in English. The analysis of the assets was in the UK. So they had the demand for this job, and that's exactly the job I did in Israel.
Right.
The only lacking skill for me was I didn't actually speak the language, English, but that didn't take long.
Sure. And that was 17 years ago.
Yeah, it was.
And that was all based in London.
Yes.
So tell me about your move from there, and how long were you with that bank?
I think about 10 years collectively.
Wow.
Between Israel and London.
Okay.
I worked in the same bank in Israel.
Right. So yeah, you just moved over to the kind of UK division.
Yes.
And that's why you were looking for the opportunity. It just kind of makes sense. But then it was time to call it a day there. What brought you to the end thinking, right, I've done my time here, now I want a new challenge, or I want to do something different, or I want to move on? Was it forced upon you? Was it a redundancy, or was it something that you just felt, I'm bored, I'm getting itchy feet, I need to do something else?
It's actually bad news that became good news. So while working in Mizrahi, I loved what I do, but I also knew that I'm done. I'm bored a little bit. I have got the department to a lovely place. I trained somebody to replace me. I'm ready to move on. And I always wanted to go to UK real estate area. And I left for maternity, and the agreement was as soon as I come back, I enter into the UK real estate market, which I did, and bank was very, very accommodating. I came back from maternity, got on that job, and this is the one case where you don't get any training. You've just been thrown in. You get the portfolio on you. You get all the new business. You get all the portfolio management. You get the whole thing on, and you need to get your head around it. And guess what? I did. I did. And then something bad happened. My partner lost his job, and I realized that I need to make more money. And that kind of pushed me out to have a look at what else is available, where else can I work and be employed. And I'm quite a loyal person, and I was very comfortable there. I absolutely loved it there. They respected me. They admired me. Cut this out. They did like me. I want to think so, but I needed to earn more money. And I knew there I won't be paid as much as I would have been paid otherwise elsewhere. So I reached out to some recruiters, and I was very, very lucky that one of the first interviews was with Octopus Real Estate,
which have done huge things.
It's incredible. Yes, it is incredible. And the second, which is really important for me, the interview I had at Octopus was for a completely different role, but the recruiter I had, the HR person I had, Laura, she was brilliant. She asked one of the most important questions that I appreciate to this day. And this is the question I ask when I recruit people. She asked me, out of everything you have done, the whole spectrum of real estate journey, and I have done everything from origination to underwriting to completion to loan management and repayment. So the whole spectrum, right? And I have done all the products as well. So your buy-to-let, your bridging, your land, your commercial, your care, whatever there is there to do, I have done it. She said, out of all of this, what's your favorite?
Good question.
And I knew what's my favorite. My favorite has always been development finance. And I was interviewed for credit risk management role, something like that. And when she heard development finance, she said, can you wait for 5 minutes here? And she left the room and she got Matt Smith, who is now with Octane, in. She interrupted his meeting, whatever he was, and he asked him to come in and interview me. And from that moment, my whole career went into development finance.
Interesting. And what was it about development finance? Because in the specialist space, I do think to a certain extent that's probably the most intricate and complicated and complex. Because especially if you've got a complex development loan, it's just, compared to a commercial term loan or a bridging loan, there's so many more moving parts, so many more reports, etc., that you need from development finance. What was it about that whole thing that you thought that's the one?
I wouldn't have it any other way. 2 reasons, really, if I think about this. First one, it's very tangible. You can see what you're funding. You can see where your money is going to. You're building something. You're creating something out of nothing, right? But second, I think the complexity in development finance appeals to my sense of adventure and the challenge. I need to be challenged. I love being challenged. The transactions I enjoyed the most are the most difficult transactions I have ever done. I can still recall them. I can still talk about the details. But I remember when I do difficult transactions, when I work on challenging transactions, I become alive. You can almost hear the sparkle. You can feel the buzz. I really love doing that. If you ask me to do buy-to-lets all day, I'll probably walk. No, actually, I will walk.
too vanilla, too straightforward.
I know some people love volumes, and buy-to-lets has got space, and bridges got space, and you churn the volumes, you cut the commission, you make a profit, the fees are being paid. It's great. But for me, development finance is the niche that has got my heart.
And so, the development finance, you did it with Octopus. Tell us about working at Octopus and overall the transition over to HDB, which is where you are now, because you were also with Octopus for a number of years, right?
Yes, Octopus was about 7 to 8 years.
So you're quite a loyal person based on your CV,
yes.
Which is something that everybody loves to see. And means you're an asset to the business. You're also enjoying working there, so kind of a good relationship going both ways. But then that comes that time where you think, well, it's either forced because it's a redundancy, it's changing the marketplace, and of course development finance is very sensitive to the market and the economy. Or was it something again that you thought new challenge, new paradigm?
Here I was quite lucky. Octopus journey was a fantastic journey. When I joined, we were just 2 people. Gavin Eustace, who is now CEO of Silbury, and myself. And we grew the whole department effectively from something very small to proper standalone development finance division, which is really amazing. It's efficient, it works well, it's got excellent reputations. I should not be promoting my competitor, but yeah, they're fantastic. And also, I think the biggest thing I'm taking away from working at Octopus, it's the culture and the way they treat people, and the passion the founder has for the business as a whole, and the founder's ability to almost infect everyone with that passion, get the buy-in from everyone with his passion and with his personality. You don't see that often in business world, and I think it's a huge privilege to be able to be exposed to that and kind of soak this in and experience it, and hopefully take a little bit of that with you anywhere you go. So I ended up getting into a position where I was heading Development Light Division. Development Light Division is smaller development loans. I know smaller. It's
refurb loans?
No. It's proper development up to maximum to 5 million debt size. Refurbs, we did some refurbs, but refurbs probably don't need that much expertise to do them, so it kind of got moved to a different department. But development speciality was our speciality. And then something quite incredible happened. And I'm here to thank Alex Upton for that. Alex is currently Managing Director of Special Mortgages in HTB. You definitely know of her. She's a legend. And she needed someone like me. And apparently what happened was she reached out to the market, and she must have given some sort of guidance on what she's looking for and who she's looking for. And she asked brokers and professionals. And the way recruiter told me the story is that my name kept coming up in those conversations. And the next thing she did, she targeted myself, and she effectively headhunted me from Octopus. And would I have moved myself? I'm not too sure. I really loved it. I loved Octopus. I loved working there. I loved what I have achieved there. But the proposition I had in front of me was so incredible that, to be fair, that was no-brainer.
Yeah, no, I mean, it's always flattering when you get headhunted. There's almost, whenever that happened, you tend to take those offers seriously, even if you were never intending to go anywhere. Because it's like, well, let me see, actually, because it's quite a nice gesture for somebody to kind of pick you out from a bunch. But at the same time, sometimes the timing is right way, and the package is right where you think, well, actually, although it wasn't on the roadmap right now, why not see which way the wind blows and take a shot? Because, again, it sounds like you have a sense of adventure within you anyway. So there's always, if somebody provides you with a compelling enough opportunity, you'd be curious enough to take it.
That's interesting you mentioned this, because
this episode is sponsored by the PLMD Group. PLMD Group is made up of the PLMD Development, PLMD Estate Management, and PLMD Capital, providing expertise in real estate development combined with asset management. With more than 70 build-to-rent properties and £20 million of assets under management, PLMD's extensive knowledge of local planning policies have resulted in a strong track record, turning liabilities into valuable assets. The group delivers value through a fusion of experience, innovative design, imagination, hands-on management, and sustainable resources. To find out more about PLMD and the services they offer, head to plmdgroup.co.uk.
as flattering as it was, the move was not about the ego. What was important to me, and I think this is a trait that is more applicable to women. What was important to me was that I knew that I can add value. The conversations I have had with Alex prior to accepting the offer and identifying the needs of the business, I was absolutely rock solid confident. I know how to make this better. I know what I'm bringing to the table. I know I can do this. I know I can do it with my eyes closed. So I was so empowered with this knowledge that I know how to add value as soon as I step into this new organization and this company. And Alex trusted me to bring that knowledge, to bring that expertise, and just revolutionize the way we work and take us to a completely different level, which we have done. Good.
And so let's get into a little bit more the development finance in particular. There's investors and developers that are our audience, and they are curious to know from somebody like yourself, how can they get their hands on 6, 7, 8-figure loans, especially around development finance. The UK's got this affordable housing crisis. There's a lot of people that think property investment and development is a great way to make a lot of money, but they need a lot of money, so they need your help. For a developer, what sort of things are you looking for in a property developer to be able to feel comfortable in backing them?
That's a very good question. First thing they need to do is to get a good broker.
That's a great answer.
That's the truth. That's the truth. Having seen thousands of transactions, not hundreds, thousands of transactions, very few developers really do know what the bank needs to get development finance in place. And those that do know, I can probably count them on on the fingers of one hand. So they need someone who knows what the requirements are, and they need someone who knows what the process is, and they need someone with the time to line up all the professionals on the requirements, all the documentation, all the paperwork, and your source of funds, and KYC, and your IMS construction package, and your legal, and all of that. And typically, this is what the broker would do. Yes, developers can do it themselves, but very few are able to do it well. If you get the right broker, this is godsend.
Okay.
The good brokers are. Actually, I have this analogy which you're probably going to like. When we get an inquiry from an excellent development finance broker, and there's only a few of them out there, when you read it, it feels like music.
Oh, wow.
It feels like
Beautiful.
a concert, because everything is there. All the information is lined out, especially the nasty bits, the surprises that you normally find out later. They would lay it all out, and they will try to mitigate it as well, kind of offer a solution. So, I'm aware there's a weakness here, but this is how I propose to resolve it. So we're aware there's a bit of an issue here, or, I don't know, think of an example right now, but that's we're proposing to increase personal guarantee to counterbalance that or to mitigate that. This is beautiful, because that gives you that speed, and that gives you the certainty of the approval. I think the most frustrating thing in my mind for the borrowers and brokers and the community is it's not just the length of the process and the complexity, I mean, of course, and lack of transparency as such. It's the way the terms change from the initial inquiry to completion. And everyone blames banks. We're not the ones changing the terms. It's the numbers that come back from the professionals that don't match, that change the terms. But more importantly, the surprises. I hate the surprises, right? You get your valuation come in, and suddenly there is something nasty coming out of that valuation. You get your IMS comes in, and you find out that they didn't account for decontamination costs, or apparently there was contamination, or they didn't account for Section 106, didn't tell you about this, or there is nasty overage hidden in the transaction, and nobody thought about telling you about this, and you only find that quite late in the process.
Also, with a good broker and a good developer that they're working together, in the application itself, the details. So, can you give me a brief, apart from the full address? Because I had days that I've been a lender, and literally people wouldn't give me at least the full address. They'd miss out the postcode or part of the postcode. It's just for me, it's a small detail, but it means a lot. But what are the key things that you're looking for? Some people say track record, some people say balance sheet. What are the main things that you're looking for in an application?
Sam, you know why I'm smiling? You may have seen that we have just delivered a development finance masterclass in Manchester earlier this month, and we did one in London as well. And the focus of my section in the masterclass, and that's the keynote speech effectively, is that inquiry and that bulletproof application, and what are we looking for in that application, and what are the key components that needs to be included, and also why we're looking for them. So that section takes about 2.5 hours. So what am I supposed to do now?
Wrap it up in a few sentences.
Wrap it up. Okay. I mean, I'm going to be repeating what everyone already knows. Of course, you got to have the full postcode and address. You have got to have your previous development experience with main focus on comparable experience similar to the projects you are proposing to fund. If you don't have comparable experience, or if your experience is a bit light in the area, be open about this, because we will find it. We will uncover this later on, and this can affect the terms of the credit approval. So be very clear about what have you done before, what's the closest to the project you've done before. Assets and liabilities is really important, and good, proper breakdown of assets and liabilities, because we end up, as part of the due diligence, we actually check the assets. We go to land registry, we go to company's house, we extract the information, so we verify the assets. If assets and liabilities is not detailed, then it can affect the ability to complete the due diligence. Another element which is relatively new now, but is important, it can actually affect the future of the deal, is source of funds. If source of funds are not coming from the borrower, some banks will not take that deal. Or if source of funds are coming from high-risk countries, this may kill the deal from the outset. So in the past, we didn't used to ask that question. This would normally be an end of the process, kind of, oh, just tell me where the money coming from, and you write a little declaration. But now, this can make or break the deal. So one of the key questions to ask is where the money is coming from. Who is your investor? Is it yours? Or is it third parties? If it's third parties, are you putting any money in yourself? And if you're not, some banks will not take it, will not work with this, right? Development appraisals, so many times, and you have seen it hundreds of times, I'm sure, developers will come and say, I'm going to build this for £5 million. Thank you. Give me the breakdown. Does this include professional fees? Does this include Section 106? Does it include decontamination costs? Does it have contingency? And if it does, what's the percentage of the contingency? Because the amount of time they will put 2.5% contingency in, but the bank may want to insist on minimum 5 or maybe even 7.5, or in some circumstances 10. If you don't have that breakdown, how on earth are you supposed to assess the transaction? Another element is actually that's the one that is most frequently forgotten or missed or misrepresented. And I'm using the word misrepresented on purpose. Purchase price. Purchase price, the date of the purchase and the funds spent on site since the purchase. Now, that is the most overlooked item in the process. And you would know that better than anyone else. The purchase price affects your loan to cost, and it affects your profit and cost. And those two parameters are key parameters in every lender's policy. If you break those parameters, the transaction might become unfundable. The risk here is that in most cases, if this information is not given to the lender early, you know when we're going to find this? In the report on title, a week before completion. And suddenly, a week before completion, we realize that the purchase price is significantly lower than the market value, meaning that either there is no cash in the deal or loan to cost covenants have been breached, which may mean that we cannot do the deal. And many lenders have got this as hard rule. So the purchase price, the date of purchase, and the funds spent on site since the purchase should be included within the first inquiry. And this question should always be asked from the borrower in order to allow us to calculate our gearings correctly and make sure the transaction doesn't change as we go.
That's interesting because I've never had anyone state that the purchase price at the beginning and the funds spent and the date was that important. And I'll put my hands up, that's not something that I put in our initial kind of IM that we send over to a lender to review. But that's interesting that you mention it, because we will start doing that. And it's good to have that sort of feedback. I guess, I mean, it's when somebody's acquired a site and they've taken it through planning, for example, those sorts of things, or when they've bought it significantly below market value for one reason or another, those sorts of things should be specified. When it comes to the application and it's gone in, and what's the process from that point on? Is it, because we either send it to an analyst or we send it to a BDM, and then kind of where does it go off? I think from a developer's point of view, it kind of goes off into the system.
Into the fog.
Yeah, into the fog, and then it kind of comes back with a red or green light. What happens from that point on once the broker submits an application?
You know, it is my dream to get the process, to make the process as transparent as possible. And this is one of the reasons why we do the educational events for brokers, because we want to be clean and clear on what the journey of that transaction. It needs to be transparent to both sides, not just us. The power is not even, and that's not fair. The fairness is coming out here. So to answer your question, when you submit that application in most cases, you're going to get initial indicative terms back, and you'll get them very quickly, which probably means an underwriter hasn't seen them, and they're called initial for a reason. It just means that the numbers have been lifted from the inquiry, plugged into the model, and the terms spit out. It means nothing. It does not mean a transaction is going to be approved or supported, or it does not even mean that those are the terms you're going to receive on the other end. But what it does give you, it gives you a little indication of, based on the numbers you provided, does it fit the criteria of the bank, as in the product type and the asset class, and just basic metrics such as profit and cost, gearing, cash in the deal. Does it fit that? And that helps you to take that indicative terms and go and try to have a conversation with the client to say, those are the terms I got. They're not worth much, but it's a first step, right? The next step is, with the terms, hopefully you're going to get some additional questions asked by the lender. And the reason they ask those questions are twofold. First, it will help them to present a deal later down the line to credit, to have proper approval. But also, and I forgot what was the second reason.
I'm sure I'll come back to you.
I'm sure it will come back to me. So the question's been asked with your indicative terms. Yes, they would often have, the indicative terms would often have some missing information in them, some gaps. And this is coming back to my previous point that when the inquiry comes in beautiful, it doesn't have the gaps, which effectively allow us to take that inquiry and go straight to credit. But if that's not the case, then we will go back and ask some questions. Once those are answered, ideally what you want to happen is you want your inquiry to go to credit. This is not yet full submission. This is not full due diligence. We're not doing the KYC just yet. You don't have valuation. You don't have the IMS, the monitoring survey report. But you have the picture that you'll be putting in front of credit saying, this is a deal. Those are the pitfalls. Those are the basic due diligence we have done. Maybe a little bit of market analysis, maybe a little bit of credit checks in the background, but not full checks because we don't yet want to leave the credit footprint. Would you support the deal? Once credit have seen the deal, that is a much better place to be. Now, but do you remember that the terms you're getting out of credit are only as good as the information you're feeding into credit. So if anything is in the package not right or not precise or missing, then the credit approval, even though it is credit approval, and you may even get an offer letter on the back of that credit approval, that's only as good as paper is written on. Because all the information that you fed in now needs to be verified by your monitoring surveyor, by your valuation, and by your legal work.
Very, very clear. The way you describe it sounds like you've been through it very, many, many times and understood that process profoundly. So this is the thing as well, there's the credit committee.
Yes.
A lot of people, I think, including myself at one point, way back when, thinks this is a bunch of people in cloaks that come in a secret meeting behind a curtain and they share around and they make or break people's lives and careers and deals and move goalposts and it's all very secretive, and like the credit committee is like we don't know who is on this secret council of. So if you can break down what is credit committee and how does it work and who's generally sitting around the table making these decisions?
Credit committees takes different shapes and forms, and I used to be credit. Before becoming deputy managing director, I was the one making those decisions. I was credit, underwriting and credit. In some cases, it is a committee. It's actually people sitting around the table. In some cases, it's just a walk through email. That transaction goes through several people and they need to opine and support. In some cases, it's just one person. Now, the key, the secret to any successful lender is the strength of credit. They need to have the knowledge. That's the first requirement. But there is another requirement, which in my view is even more important. We sell risk. None of our transactions is straightforward. None of them. I have not seen a single straightforward transaction in my entire career. Yeah. We sell risk, we take risk, we price for risk, we charge for risk, right? So yes, every single deal will have its quirks. But are we prepared to take the risk? Yes, we are. How much we're going to charge for the task? How much we're going to charge for it? How are we going to mitigate the risk? This is how we mitigate the risk. They need to have the balls to make those decisions to back the business. If you hire an underwriter or a credit person who is too conservative, that will absolutely choke your business, and that's just a no-go. I'm pleased to say, where I am right now, we have an incredible credit people. The level of knowledge they have is absolutely astonishing, but also the open-mindedness and the understanding that in order for us to achieve our objectives and to serve our developers community, they have to take risk and they have to make bold decisions. It's there and they do it, and that is incredible. And
with HTB, where you are currently, is there a goal for how big the loan book should be?
Oh, triple the book in a couple of years' time.
And triple, what is that? No, like, is that 10 million, 100 million?
No, 750 million pounds in as short space as possible.
750 million. So not a small amount of money.
It's
then.
Not astronomical either. Yeah.
It's not astronomical. Depends on your perception of large numbers. But that sounds like a lot of money to most people. Now, development has been slow over the last 18 months.
Yes.
We've had rising build costs. We've had high inflation. We've had higher interest rates. What's been the approach that you've had personally within a development finance team to stay busy, to stay positive, that a lot of deals might not look like they're stacking up, or they might be marginal. And when something's marginal in a difficult market, should we do it? How do you kind of process all of that when you're in the eye of the storm?
This is such a good question, Sam. Thanks for asking this. I didn't give you the questions in
No,
advance.
you did.
Disclaimer. What I saw in the market and in HTB, some lenders, especially last year, was a bit of nervousness around the market, and some lenders chose to go a bit conservative and pull back the gearing. And we have had discussions about pulling back the gearing. The beauty is, both myself and Alex at the time, we're quite bold. And we were adamant that we're not touching the gearings. We're not pulling back, we're staying strong. And the reason for that is, when your market turns, and any conditions, not just last year, if you think about the credit crunch, when market turns, the first people to pull back the numbers are valuers. They will be the first ones to build in the safety net, the 5% discount, the 10% discount, the material uncertainty clauses suddenly start showing up, right? They're pulling back the gearing first. If then I am, as a lender, getting that valuation that has already been down, I don't like to use the word down val because that's not the thing, but if that valuation is already conservative as it is, and on top of that, I'm overlaying this with restrictions on loan to GDV, so I'm now at 65 and say I want to be conservative, I'm going to 60, I'm double whamming the market, I'm double shooting the market in the foot here, right? But the thing is, that transaction I'm looking at today, this will materialize and get out to the market to sell in what, 2 years' time? 2.5 years' time? Year and a half time? By that time, we're going to bounce back. We always bounce back. The supply-demand imbalance in this country is so insane that we will always bounce back. The market is strong, especially London Southeast. Okay, that's stating the obvious, but we will get back. So by shooting the market today, I'm actually not helping anyone, and neither myself. By the time those units are out, the market will correct itself. What's going to suffer is my current book. The units that are becoming available for sale on the market today, that's where I need to focus my attention. This is who I need to look after, right? Not the new transactions. So last year, we held our fronts in all areas. We held all our gearings, all our criteria, and we remained very, very strong with quite aggressive appetite. The one thing we did do, which is quite bold, and I'm quite proud of this, we reduced our profit and cost requirements. And you would know this very well. Some lenders insist on 20%, some go to 15, and if it's below 15, kill the deal, doesn't work. We went all the way down to 10%. And it is ballsy, because 10% is a borderline where you think, why even developing, right? Yeah. But there are so many reasons why developers will still go ahead with 10% profit on cost. And name the few. They may have purchased the site at a time when the build costs were normal and inflation wasn't there just yet. Now, they already invested, they're already sitting on the site, right? What are they supposed to do now? Cut losses, play planning, and it's wonderful if you can play the planning. What if you can't, right? Yeah. So they're sitting on the site, they're stuck with it, and maybe they have in-house construction teams they need to deploy. So this could be perfectly great developers, experienced people with track records, with impeccable history. They have construction people to deploy. If they don't do that, they're going to lose them. So would I not fund those people? Of course I'll fund those people. So we dropped our profit and cost requirements to 10%. And even on occasions, we will consider lower than 10% if there is a story behind it and it makes sense. Also, you may deliver your site thinking, okay, I'm making 10% today or 11% today. But guess what? In a year's time, in 2 years' time, 3 years' time, who knows? You might be on the money.
Yeah, exactly. That is a fascinating insight, I think, for a lot of people. Certainly, the horizon of 12, 24 months, okay, we're in the eye of the storm now, but hopefully by the time the development's done, we should be out of it. And then the idea that the lender, that you can slightly tweak some of these levers, which is take a little bit of smaller profit on cost, just to get the really good developers, the really cream of the crop that are full-time doing this stuff, keep them alive so that we can kind of survive to another rainy day, to a sunny day rather. You can kind of keep supporting them. There's one word that you used in there as well, which was down value. You said you don't like that word. And you know as well as I do as well, everybody uses it, or used a lot at the very least. And tell us why you don't like that word.
I'm very analytical. And when I read valuations, I read them. I don't just take the number. I go and read the report, and then I jump on a call with valuer and I talk through what's the rationale, why is it here, why did you reduce the numbers, increase the numbers, why are you agreeing or disagreeing with the borrower. And when the valuation is done right and your comparables are right, quite often while reading that report, you can almost see what the GDV is going to be without even getting to the page with GDV. I think the reason down val is not the right word in my view is that sometimes the borrower's coming in with quite optimistic view of what they're going to achieve from the development, and almost everyone, 9 out of 10, will say, "Oh, I'm gonna beat that. I'm gonna over-deliver." Yes, you will over-deliver if the market goes up as it has done for many years, and people are used to it. The habit of market just outperforming, but that's the market. That's not you delivering anything special. This is just the market supporting that capital growth, right? So when you read the valuation and you see the comparables, especially if those are the right comparables, and then you see the number in the end, the GDV, that's the number, that's the right number. The fact that it doesn't match the developer's expectation has got nothing to do with downval. This is the reality, this is the expectation. 9 out of 10, when I feel that the valuation didn't do justice to the project, I would go to the client, to the broker, to the borrower, and I would say, okay, here is the report, read it. Have we missed any key comparables that you have seen that caused you to think that your GDV is going to be higher? And if we have, give them to me. I'm going to go back and renegotiate for you. And I do. Now, we need to be very careful. We cannot influence the valuers because there's all PI and all of that. But if there are comparables that have been missed and they are genuine, true comparables, there's nothing stops me from taking them, sending them to the valuer and say, okay, reassess. Have you seen this? Did you take this into account?
Yeah, exactly.
And if you didn't, why didn't you? And then we have the conversation. And sometimes they will adjust the numbers, and sometimes they don't. They won't. But there is a conversation to be had.
Exactly. The down value assumes that the value is the value, and it's been valued down from that. But actually, most cases, there's no evidence to suggest that it was that value in the first place. So the terminology is can be slightly misconstrued. So. You mentioned a few times as well, like very experienced teams and developers that's got impeccable track record, for example. What about first-time developers? Is that something that, I mean, what's your take on first-time developers? Because I know that some lenders won't work with them because their funding lines and their pricing and everything is structured as such. And some will, broadcast that we will definitely lend to first-time developers, and they will price again and put the LTGDVs as such as well. What's your take on first-time developers, and what would be your advice for first-time developers that are watching this?
That is such a tough question, but thanks for asking.
That's what we're here for.
Anywhere I worked at previously, first-time developers is a tough sell. It's not within the core offering. The circumstances in which first-time developers can get reasonably priced finance is when we're looking at low gearing and very deep pockets, and exceptionally experienced team. Now, when we talk about very, very deep pockets, this is not to cover cost overruns if they happen. This is to cover cost overruns when they happened. And it's guaranteed that they will happen, right? And every single transaction with first-time developers, every single inquiry coming across, everyone will say, oh, they have experienced team around them. But when you look at the experienced team around them, they're not that experienced. Like, you really need to dig deep. Who are the people behind it? What the bank may want to do to make this work is, apart from lowering the gearing and increasing the contingency, they will look into potentially getting collateral warranties and duty of care letters and direct contractual relationship with the professional team. The downside of this and the whole big challenge here is those first-time developers would typically look at smaller transactions first, the building, the 2 houses, the 3 houses, etc. The size of those transactions does not justify the amount of effort and work the lender will need to put in order to make this work and in order to get comfortable. If you think about collateral warranties, it's such a pain to put the whole thing in, right? All of your consultants and your architect and your M&E and so on. If you try to drag somebody who's never provided collateral warranties because they're small players to provision of collateral warranties, that's going to hurt everyone in the process. Is it possible? Yes, it is. Is it economically viable? Not really. That is why so few lenders are actually prepared to go down this route and offer the finance, but they will cut the coupon. They will charge appropriately to remunerate themselves for that.
Fair enough. And with developers that are both experienced and first-time developers, what are the most common mistakes that you see developers making through projects, either when they're at the application stage or even mid-construction when you're kind of in the middle of a development loan? What do you find that is something that comes up often?
Well, at initial inquiry stage, where do I start? This is a lot, right? This is a lot. Throughout construction itself, you almost want to have a project manager or site manager with this German precision around timing and processes. What do you need to order? How much of that you need to order? Did you measure? Did you have your specification right? Did you get everything you need in advance early enough so that you can plan? Think about utilities. The utilities is a walking, talking joke, right? You need to get utilities booked in 8 months before you even start the job. Not 8 months, but you know what I mean. Before you even need to lay down, you're at the mercy of utilities companies. You need to have those connections. You need to know who to talk to, and each utility provider will come and lay the utilities at a different time. And you may need to dig the same road several times because each utility provider has got its own timeline. And so, you're laughing. You have done this before, right? So somebody who understands this inside out and can plan for this correctly is gold. Right? Somebody who understands planning system knows how to submit planning conditions for discharge in advance correctly and get them discharged in advance is gold. Somebody who understands what the funder needs, because there's little things that can prevent you from getting your funding. Think about new build warranty, for example. Can you get new build warranty halfway through? Yes, you can. Is it going to cost you a lot more? Yes, it is. Will you struggle to get your finance development tranches released if you don't have new build warranty? Yes, you will. The teeny tiny things that the borrower may not think about that will prevent him from getting money on time, fast, and will slow down the whole project are key. So I think this lack of planning is probably the big one. And of course, we cannot control inflation and surprises on the market and suppliers going bust and etc. Within the inquiry stage, it's all coming down to money. And the reason I'm saying this, you can speed up development finance transaction 3 times. How can you do that? Simple. You get your valuation instructed upfront, you get your monitoring surveyor instructed upfront, and you get your legals instructed upfront. It takes about 2 to 3 weeks for those professionals to finish the piece of work they do. And of course, the outcome is dependent on the quality of information you provide in. But in order to provide quality package, you need to pay. You need to pay your own construction guys to get the package ready. You need to pay the subbies, the tender. You probably want to go through tender process to get some indicative terms out of them. If you're prepared to spend the money up front, the speed of the development finance transaction can be tripled, as in it can be done 3 times faster than the usual process. But it costs money, because you need to pay the professionals to get the things done. Most people will go step by step. So you'll do your valuation first, you'll do your monitoring survey next, and then you'll go your legals final. That's weeks and weeks and weeks of work. But I understand why it works this way or the other way from the developer point of view.
Yeah, some of them. I mean, I've had it go. You've probably too as well done it so many different ways, and you've seen almost everything sometimes where the developer just, right now I've got one where they just want to make sure that the values come up. Larger single unit, high value single unit detached houses, and there's a little bit of a debate as to whether we're going to hit these 7-figure sums on each of these units, and depending on how far it drops, it might just completely break the back of the deal. So although they've got planning, it might not be feasible to even build this thing out. So they just want to get that first. Then if that marries up, happy days, then we'll get the QS report as well, and then we'll do the legals. And they've got a bit of time on their side. But I've seen it the flip side as well, where they get everything done up front because they're really keen to get into the deal. One of those pieces falls out, and they've wasted loads of money on undertakings with solicitors and this, that, and the other. So on the next occasion, they've been a little bit more cautious in their approach. So yes, But I do agree that they just need to be a little bit more organized, and sometimes it just comes from experience. Like, you don't know what you don't know, and if, don't know that you've got to get your utilities organized. Unfortunately, it's not crystal clear. There's no handbook to someone to say that
No.
you need your warranty provider right at the beginning, and sometimes they get caught out, or they were disorganized, or somebody said that they did do it and they didn't do it. I've also had those sorts of situations where they relied on a project manager to get something done. It was like a post-practical completion condition from the planning side. They just didn't do it, and then the refinance at the back end was just delayed because of that thing, and they were relying on the consultant that they. So it's. I was speaking to a very, very good developer, one of my favorites actually, and he basically says that the developer needs to know everything, and that's the whole reason why they get paid the most at the end. They need to be on top of every single angle, and that can only come from years and years of experience. You have to make all the mistakes to make yourself a little bit better for the next deal, a little bit better for the next deal, and that's it. That was his solution.
But you can't.
Conclusion.
It's unfair. You can't.
It's impossible. So you've got to kind of just pick up the bruises along the way.
You do, but also you need to build up or meet the right people, the right professionals. There are very few excellent real estate lawyers out there, but once you find one, you hold to. That's the guy you go with. That's the guy you drag through every single transaction, and you pay whatever fee they charge because that's the gold, right? So you cannot know everything. I have been doing this for more than 20 years. I'm still learning, right? Absolutely. So there's no way developers can learn everything about each transaction, but get the right professionals lined up, people they trust, people can rely on, people who will work for them and protect the business, the project, the way as if it's their own. I think that's the key.
That is the key. I completely agree with that. And from a over 20-year period, how have you seen things like development finance evolve? I was just speaking to another lender on an episode we've just recorded, and they were talking about AI in the underwriting process, and that's already something that I think it's not in the future. The future is now. It's happening. Where are you at with it? What are the conversations in your office? Are underwriters going to be taken out of the equation entirely, and it's just going to be a computer that's going to make a development decision? What are your thoughts?
Oh, that is such a beautiful question. Because I actually had debate about this recently with several people. And my view is that development finance underwriters are going nowhere. Nowhere. You cannot predict the outcome of development finance inquiry. I think I have even written an article about whether AI is going to take out the underwriters in development finance. Having been an underwriter myself for many years and having been credited for many years, one of those that locked in the back room, doesn't talk to people, although I did talk to brokers and borrowers. When you look at a transaction, sometimes the positive decision is not driven by ticking boxes. Sometimes it's the gut feel, and it's the bigger picture, and it's something you see there that gives you this confidence that this is going to work, even though on paper it might not look like the best deal ever, right? And if you give this to AI and you give some sort of algorithm to make those decisions, this is going to go horribly wrong. Every single one of those deals is unique, and that's the beauty of it. Maybe buy-to-let bridges might work on this concept, but development finance will never do, and I truly believe in that.
Yeah, no, fair enough, fair answer. It was a similar answer that we got as well. The underwriter's job will be more so risk-based. It'll be just actually assessing risk. So the AI could make the IM quite accurately and say where the comps are and make sure that all the data is verified and create a summary of all the different reports, but then that risk decision will be on a human to get that gut feeling.
Yes.
And all it could mean is that we're going to increase the number of deals that we underwrite in the same period of time. So it could speed us up a little bit, which is still a great achievement in itself. So from a loan book, how, especially in tough times, there's a lot more developers that we've been arranging exit finance for example, giving them that little bit more time just to be able to exit the development loan, which is happy days, you get your money back, but at the same time, for them to either refinance onto a term loan or sell to the market. Defaults and repossessions. What percentage of a loan book is it reasonable to have? Because when you're putting out so much money, it's almost impossible, I think, to be able to have a perfect loan book where everything is hunky-dory. Is there a percentage that is deemed acceptable in a loan book that is like, okay, 1% of it goes a little bit pear-shaped, or is it 10%? Is there a number that you work towards?
I think that will very much depend on how aggressive the funder is. To a degree, if your defaulted book is too small, that may suggest that you're too cautious in your risk profile. And that is almost a conversation to have with the funder. So, well, actually, we are too careful, we are too conservative. That may mean that we'll be missing part of the market, and we can allow ourselves to go a little bit more ballsy. But of course, if your losses are too high, I don't know, in excess of 5% probably, I'll probably think that's too high. This may push the lender to pull back and dial down the gearing and stuff, which means the current book will start shrinking. It's a double-edged sword, isn't it? So you want to have a defaulted book, as in it is the nature of our beast. We sell risk. That's what we do. Some of those deals will go wrong, and more so, some of the deals that were perfectly fine at underwriting stage, and I had one of those. I had to pinch myself. It was an absolutely beautiful deal. It ticked all the boxes. AI could have approved it. Ticked all the boxes, and I remember going to completion thinking, "There's no way. I must have missed something. Like, this cannot be a perfect deal. This is the one perfect deal I have had in my entire career." Guess what? It did go wrong. But it went wrong for reasons that nobody could have predicted from the outset. So we sell risk, things will go wrong, we'll just deal with them. When the percentage of losses go too high, it's damaging for the lender, because the lender will pull back the gearing and the book will start shrinking. And also it sends quite concerning message to the market as well. It's, the broker's confidence falls down, the borrowers become uneasy about the lender who cannot provide steady flow of finance. So it's quite damaging. But having some losses, it's just the nature of the beast.
Nature of the beast, I completely agree. And something that we were talking about when we, earlier before we started recording, was the importance of women in property development and property development finance in particular. Having been, I was half joking with you, but I was kind of serious that the first, I don't know how many episodes of this podcast called Property People, I was very close to changing the name to Property Men because there was no women on it. Everybody knows that, everybody agrees that it's a predominantly male-oriented environment. My wife's in engineering, it's similar for her industry. But with yourself being really, really successful, done some amazing things and highly regarded after, what would you say to other women that are thinking of joining the industry, and what can we do to try and increase diversity within property finance?
That's a very good question as well. Thanks for asking this. About a year ago, we had a chat with a property firm that approached us, myself and Alex, and they asked for some tips on how to hire more women. And first of all, that's men-only company, and they were very consciously trying to bring more women in, and they struggled. They said, well, we advertise the position and only men apply. And we had a really good 2 hours debate about how to bring women in. Now, we don't struggle bringing women in, probably because we are women ourselves, and we act as role models, and when we interview women, we understand what we're looking for, we understand what we're listening into. But men probably interview slightly differently. So we had to really try to formulate what does one supposed to do to bring more women in? And there are multiple factors here. First, I think it's the awareness and the role modeling. Being a woman in development finance or in real estate, it's almost our duty, my duty, to be visible. Because by being visible, I'm showing to all other women, maybe younger women, that this is possible, this is really exciting, this is amazing, I'm doing really well, you can do that too. Second thing is, development finance The key to success, uh, amongst many other elements, is attention to details and ability to multitask. And women are great at this. We are great at multitasking. And our attention to details is superior. Think about all the mothers who balance the works and the children and the husband and the house needs and cleaning and all of that, right? Development finance is all about multitasking. Remembering what did you read in IMS report 3 weeks ago, compare it to the valuation, and then you're reading report on title, and that number doesn't match that number, something is not right, and then you start connecting the dots. We are great at this. So they were designed to be excellent in development finance. Why don't we have enough women in there? So role modeling first. Women are inherently great at being able to deliver exceptional results in development finance. So what do? How do we bring them in? Hiring is challenging. We do have more male candidates for every role we advertise. The one thing we do try to do, if we do have female candidates, we try to actively encourage them to come in and at least to have the interview. That's the first step, right? The second step is women interview differently. And you would have seen the research so many times. If you have 10 requirements for your job and women only meet 6, the chances are they won't even apply. While men might be meeting 3,
up the other 4.
They're just going to come, right? They may not even they may not meet any requirements. They're still going to come and they're still going to sit there confidently. And
the 6 is very strong and it'll make up for the 4.
I know, exactly. So women wouldn't go for roles where they don't 100% know. That's why when I was
confidence thing then perhaps.
It's very much confidence thing. When I was rewriting the job description for our underwriters, I purposefully removed as many requirements as possible. Purposefully, because I know exactly how women are going to look at it and think, oh, I don't have that. Oh, I haven't done this. And they won't apply. So we purposely made it a journey rather than a tick box exercise with recruitment. And when you do interview women, you need to look deeper. As women interviewing women, we have it. It's inherent in us. We can see it. We can see the insecurity. We can see the women when they come to interviews, they will focus on what they're not good at. And this is outrageous. They will tell you which elements of the job they're not going to be good at. They will not tell you which elements of the job they're going to be excellent at. And that's the one thing you've got to extract out of them. And finally, I reached the conclusion that if I want more women in development finance, I need to hire young and I need to train. And this is what we have been doing.
And hopefully the people that are watching this as well will be inspired from hearing all of your career and how well you're doing, and which is a lot of the reason why I put Property People together from the outset. Couple of quick kind of personal questions. What is the worst piece of advice that you've ever received?
Oh. Can I take a moment to think about it?
Of course.
Master and Margarita, written by Bulgakov. It's Russian classics. There is a saying there, the Satan, who is the main character, he gives advice to the female character. And the advice sounds something along the lines that never ask. Whatever you deserve, whatever you're entitled to will come to you. And I read this when I was a girl in the school and I was in 5th grade or whatever. And I thought, oh, this is so elegant. Just, do your best and you will be given that promotion and you'll be given that next step and you will be given that support. And what I realized and what I learned is that is quite harmful. That's not a good advice. If you're good at something, be loud and proud. If you think you deserve something, go and say that you deserve it. If you think your next career step is that and that's your target, make sure you are vocal about what you want to go, where do you want to what do you want to achieve, where do you want to go. And actually, I recently had a conversation with a younger female member of my team who requested a meeting, and she sat there and she was very nervous and she said, I joined the company and I did this and this and I proved myself and I'm excellent. I'm hearing really good feedback and I know I'm doing a really good job. I deserve that next step. And I felt so proud. I have goosebumps right now talking about it. I felt so amazingly proud of her for doing this, for taking this step, because I know so many women will not do that. But it's applicable across the board. If you want something, go and get it. Do not sit and wait for this to come your way.
Very, very, very powerful. In the same breath, what is the best piece of advice that you've ever had?
Oh gosh, I got to think. I don't take advice very well. I just go and learn it myself. Be unapologetically yourself, maybe? To be fair, this is what I'm saying to people. Be you. Be unapologetically you. That's my advice.
I remember the first time we met, actually, it was at the top of the Shard.
Yes?
And I got really good energy from you then. In fact, I think at that time I invited you straight on here. I thought you'd be a really fascinating person to interview with your length and breadth of kind of understanding of one of my favorite topics, which is development finance. And it seems like this genuine enthusiasm and passion that comes out from propping up other people as well, and especially women in the industry. This is all about property people, this podcast, hence the name. And you're a successful property person. What characteristic traits do people need to be successful in property?
Integrity. Integrity. This whole industry is built on connections, networking, and trust. And it's a small industry. I think once you break that trust, it goes pear-shaped very quickly because people know, people talk to each other, we talk to each other. Being bold and being a dreamer as well. I always say developers are dreamers. They see the future through pink glasses, and they got to do it this way because if they had the feet on the ground, if they had my mind, credit mind, they will never go into development. Like there's so many risks, there's so many pitfalls in the process, but they need to see that future. They need to see those homes. They need to see those sales. They need to see those profits. They need to, because that's what drives them. That what helps them to take those risks and go in and do this. I have huge admiration to developers in the industry because there's so much there's so many hurdles you need to go through to get there. And they need to have that strong sense of determination and that belief, almost optimism that, yeah, this is going to work. I'm going to make this work. We're going to get there, right? So hats off, admiration for that. But yes, a bit of optimism.
Bit of optimism, bit of integrity.
Lots of integrity.
And that's, I think, a great way to wrap this up. And I hope that, let's say, 18 months from now, 24 months from now, when the market hopefully has turned the corner and we're starting to see the opposite of what we've just seen, which is GDVs higher than what we underwrote, lots of successful developers, we can come back, have a conversation, and see how we've grown HTB's loan book.
Sooner than that. Thank you very much.
Thank you so much. Cheers.